Warren Buffett is renowned for his wisdom in the world of investing, and one of his most celebrated quotes centers on the importance of patience in the stock market. He famously remarked that the stock market is a device for transferring money from the impatient to the patient. This simple yet profound statement has resonated with investors around the globe, shaping how many approach their investment strategies. By emphasizing patience, Buffett encourages individuals to focus on long-term growth rather than short-term gains. His philosophy has become a guiding principle for countless investors, reminding them that enduring success often requires discipline and a willingness to wait for opportunities to unfold. The term hodl has become synonymous with patience in the world of investing, especially within cryptocurrency communities. It encourages individuals to resist the urge to panic sell during market downturns, emphasizing the importance of holding onto assets despite short-term volatility. This approach aligns closely with the widely adopted buy and hold strategy, which advocates for long-term investment rather than frequent trading. Many investors believe that maintaining composure and sticking to their positions can lead to greater returns over time. The popularity of hodl reflects a broader sentiment that emotional reactions to market fluctuations often result in missed opportunities. By remaining steadfast, investors aim to benefit from the overall growth of their chosen assets. Ultimately, the mainstream interpretation of hodl centers on cultivating patience and confidence in one's investment decisions. Compounding is a powerful force in investing, allowing returns to build upon themselves over time. When combined with long-term market growth, it creates a compelling case for patient investing. Historical examples, such as the sustained rally of the S&P 500, demonstrate how investors who remain committed over decades often see significant gains. Despite periods of volatility and short-term setbacks, the overall trajectory of major indices has been upward. This pattern highlights the benefits of staying invested and letting compounding work in your favor. By resisting the urge to react to market fluctuations, patient investors can harness both growth and compounding to achieve substantial wealth over time. Mistaking inaction for strategy can be a costly error. When challenges arise, simply choosing to do nothing and hoping for improvement rarely leads to meaningful progress. The just hold on approach may offer temporary comfort, but it often overlooks underlying issues that require attention and adaptation. Without a clear plan, waiting can result in missed opportunities and increased vulnerabilities. Effective strategy demands thoughtful analysis and proactive decision-making, not passive endurance. Recognizing the limitations of inaction is essential for navigating complex situations and achieving long-term success. Patience is often cited as a virtue, but for professional investors like Warren Buffett and Benjamin Graham, it is a disciplined strategy. Their approach emphasizes waiting for the right opportunity before making any investment decisions. Rather than rushing into the market, they advocate for thorough research and careful analysis, ensuring that each purchase is justified by solid fundamentals. This form of patience is not passive. It requires vigilance and the ability to resist market hype and short-term trends. By exercising restraint before buying, investors can avoid costly mistakes and position themselves for long-term success. Buffett and Graham's practices highlight that true patience is about timing and conviction, not simply inactivity. An impatient investor is characterized by a tendency to act quickly, often driven by the fear of missing out on potential gains. This investor may rush to buy assets without thoroughly evaluating the market or considering long-term implications. In contrast, a disciplined investor takes a more measured approach, carefully analyzing opportunities and waiting for the right moment to enter the market. By resisting impulsive decisions, the disciplined investor aims to minimize risk and maximize returns over time. This distinction highlights the importance of patience and strategy in achieving investment success. Warren Buffett is renowned for his disciplined approach to investing, often likening his strategy to waiting for the fat pitch in baseball. Rather than swinging at every opportunity, he patiently waits for investments that meet his strict criteria, ensuring a higher probability of success. This selectivity allows him to deploy capital only when the odds are strongly in his favor. By resisting the urge to act impulsively, Buffett minimizes risk and maximizes long-term returns. His philosophy underscores the importance of patience and careful analysis, demonstrating that sometimes the best decision is to wait until the right opportunity comes along. True patience in investing is not about ignoring daily fluctuations in stock prices, but rather about focusing on the underlying business fundamentals. Investors who exhibit real patience understand that short-term market movements are often unpredictable and do not reflect the long-term value of a company. Conviction, the confidence to hold through volatility, is built on thorough research and a deep understanding of the business, its industry, and its prospects. By grounding decisions in detailed analysis, investors can remain steadfast even when prices swing, trusting in the strength of their investment thesis. This approach separates disciplined investors from those who react impulsively to market noise. Many people fall into the trap of making impulsive purchases, often driven by excitement or the fear of missing out. Instead of taking the time to research or fully understand what they are buying, they rely on patience, hoping that things will work out in the long run. This approach can lead to disappointment, as patience alone rarely compensates for a lack of preparation or knowledge. Without careful consideration, buyers may end up with products or investments that do not meet their needs or expectations. Recognizing this common mistake is the first step toward making more informed decisions and avoiding unnecessary regret. In today's fast-paced financial landscape, it's easy to mistake patience for stubbornness, particularly when dealing with speculative or underperforming investments. Many investors hold on to assets, convinced that time alone will turn the tide in their favor. However, this mindset can lead to prolonged losses, as hope replaces objective analysis. True patience involves careful evaluation and the willingness to adapt strategies when circumstances change. Stubbornness, on the other hand, often manifests as an unwillingness to accept new information or cut losses. Recognizing the difference is crucial for making sound investment decisions and avoiding the pitfalls of emotional attachment to failing ventures. The sunk cost fallacy occurs when individuals continue investing in a losing endeavor simply because they have already committed resources, such as time or money. For investors, this often manifests as holding on to declining assets, hoping for a turnaround that may never come. Emotional attachment to an investment can cloud judgment, making it difficult to accept losses and move on. Many justify this behavior as patience, believing that perseverance will eventually pay off. However, true patience in investing involves rational decision-making, not clinging to hope. Recognizing the difference between strategic patience and emotional bias is crucial for long-term success. By understanding the sunk cost fallacy, investors can avoid letting past investments dictate future choices. Time acts as a powerful magnifier in the world of investing. When an investment is fundamentally sound, its value tends to grow and compound, rewarding patience and long-term commitment. However, the same principle applies to poor investments, where flaws and inefficiencies become more pronounced over time, often leading to greater losses. Simply waiting longer does not transform a weak business into a successful one. Patience can only benefit investments with solid foundations and growth potential. Without these qualities, time will merely expose and exacerbate underlying problems. Therefore, careful analysis and selection are crucial before committing to any investment for the long haul. Patience is often misunderstood as simply waiting for results, but in the context of investing, it takes on a much more dynamic role. Rather than being passive, patience becomes an active discipline that guides decision-making and helps investors stick to a well-constructed strategy. This approach involves resisting the urge to react impulsively to market fluctuations and instead focusing on long-term goals. By reframing patience as a deliberate practice, investors can maintain clarity and confidence throughout periods of uncertainty. This mindset supports thoughtful analysis and consistent actions, ultimately contributing to more sound investment outcomes. For investors, patience is a crucial asset. Developing a strong understanding of the market takes time, as does building sufficient capital and refining your investment thesis. Rather than relying on hope or speculation, prioritize thorough research and careful verification of information. This disciplined approach helps minimize risk and supports more informed decision-making. By focusing on facts and maintaining a steady commitment to learning, investors can position themselves for long-term success. Remember, sustainable growth is often the result of consistent effort and prudent choices. Emotional investing often leads individuals to make decisions based on fear, excitement, or herd mentality, rather than careful analysis. In contrast, rational process-driven decision-making relies on systematic evaluation of data and adherence to a well-defined strategy. This disciplined approach helps investors avoid impulsive reactions to market fluctuations. It's important to remember that every trade in the market involves a real transfer of money between participants. When one person buys, another sells, and both believe they're making the right choice. The difference lies in whether those choices are guided by emotion or by a thoughtful, consistent process. Disciplined patience in investing offers significant rewards. By taking the time to build knowledge and prepare carefully, investors can achieve a greater sense of safety, knowing their decisions are well-founded. This approach fosters peace of mind, reducing anxiety and uncertainty about market fluctuations. With a solid foundation, the process of investing becomes easier and more manageable. Ultimately, the combination of preparation and patience leads to more confident choices and a smoother investment journey. In summary, we've explored some key principles that can guide successful investing. However, every investor has their own unique approach and set of rules. We invite you to share your personal investing guidelines and insights. Your experiences and perspectives can help enrich the conversation for everyone. Additionally, if there are quotes or ideas you'd like to see analyzed in future episodes, feel free to suggest them. Together, we can continue learning and growing as a community.